Hey, Mark, just talking about oil backing off. I mean, what's your outlook for oil right now?
Well, I think that we've gone up from $10 in '98 to 145, and demand in the Western world is slowing down. And I wouldn't be surprised to see oil drop, say, $30 to around $100. That wouldn't surprise me at all. But I think that in the long run, the outlook for oil is rather that the market will remain very tight at the time when supplies cannot be increased meaningfully. And then we have geopolitical problems that can blow out. And so I would rather see in the long run higher prices than lower prices. But having said that, I took a negative view about industrial commodities for the second half of 2008, and I stick to this view.
So short some of these commodities, be it oil, be it gold, be it, well, maybe not gold, but, some, is that what you're saying?
I leave the shorting to more courageous people than I am.
All right. But nonetheless, you're looking for a lower market when it comes to a lot of these commodities in the second half.
Yes, correct. Yes, and also for lower steel prices, for lower tanker rates and so forth, freight rates.
All right. What about something like coal? Because that's something that certainly had a nice run up as well. That also?
Yes, also.
All right.
I mean, that whole sector of the market, I wrote not long ago that I would do some preventive selling. And actually, Barron's interviewed me a while ago, I think it was like 6 weeks ago, and I recommended as a short U.S. Steel.
Short U.S. Steel. And what do you like that's out there at this point?
Well, I don't like it because it's a very cyclical industry. And if global demand is as weak as I think it is, then prices will come down. And let me explain you something. We have had credit growing at the beginning of 2007 at an annual rate of over 12% per annum. And since then, it slowed down to an annual growth rate of about 4%.
Okay.
And I tell you, I have never seen in my life such a credit growth deceleration in such a brief period of time.
All right.
And that will have a very, very negative impact on the economy. That's
Mark,
very sure.
One last thing I wanted to ask you, Mark, and that's something we got yesterday, news of GE tapping into sovereign wealth money, hooking up with an Abu Dhabi development company. Interesting development, sign of the times. We're going to see more of this. What do you think?
Well, I think that it's very clear. We have this huge reserve accumulation in the world from $1 trillion in 1995 to now over $6.7 trillion. And all these reserves that are controlled by governments, they then flow into sovereign funds that want to use the money in a better way than to buy treasury bills and agency securities and CDOs. So they want to buy stakes in large companies and do joint ventures. And very clearly that will also happen with the Asian sovereign funds. The Chinese are particularly keen to buy resource companies. And I should like to warn the Western world that if the Western governments do not allow the Chinese to buy into resource companies, that eventually the Chinese will take the resources themselves by force. Because for their economic well-being, to have secure supplies of vital resources like oil and copper and iron ore is of paramount importance.
Mark, Eric Schatzker here. We're seeing this happen with GE. Seems particularly interesting or relevant given the fact that GE, short interest in GE is up, the short interest ratio in GE is up, hedge funds are making the bear case for GE. Are we going to see other industrial companies strike these kinds of deals with investors in the Far East, in the Middle East, because they want long-term shareholders who aren't going to lend out those stocks to speculative shorts?
Well, I think that's quite possible, and the time frame of some of these sovereign funds is, of course, very different than a performance-minded hedge fund. But let me remind you that so far a lot of sovereign funds haven't made very good investments because they bought into financial stocks about 50% higher than they are now.
It's Ellen Braitman. I'm here with Carol as well. And one thing that's interesting, besides additionally looking for capital from overseas, we're seeing the deal flow pick up again, particularly, it seems, with companies that are really being hard hit by the surging commodity prices. Do you think it's going to continue? And what's the takeaway? What do we need to be looking at with these kinds of deals right now?
Well, I think that the resource sector is still going to be very attractive from an Asian point of view because, as you know, China has a huge demand for certain commodities which they don't have, in particular iron ore, and they're poor in copper, and they need, obviously, oil. They're now the second largest consumer of oil in the world, and that consumption will continue to escalate. And the same will happen, by the way, in India. And so I think that these type of deals will obviously accelerate in future, especially as these reserves continue to grow very, very rapidly.
Marc, bottom line, where do you see the economy, the global economy, the U.S. economy in the next 6 to 12 months? Is it more negative or more positive?
Well, basically, if you look at this global synchronized boom we had over the last couple of years, it's unprecedented in history, and I think the bust that will follow will also be unprecedented in history. And if you look at the sequence of how the boom came about, expansionary monetary policies in the US leading to strong credit growth, leading to asset inflation, and then leading to consumption, then exports from China, China driving the demand curve for commodities to the right, resulting in higher prices. And that can all go, this virtuous cycle, into a vicious cycle on the downside. And when oil prices go down significantly, I would like you to go to the Middle East and see how some of these boom towns then look like.
30 seconds left. So this bust, what's your worst case scenario here?
The worst case scenario? Well, I think the worst case scenario is a colossal bust with inflation, and I think there's a very good chance that we will have bad economic environment, but still rising prices, simply because we have money printing institutions around the world called central banks.
Okay, we're going to leave it on that note. Marc, thanks so much for all your time this morning. You have a safe trip back to Asia.
Yes, thank you very much.
Marc Faber, founder and managing director of Marc